let's talk about, though, what the tax implications are of direct indexing.
Well, the tax implications, I mean, it's sold right now to the public by everybody as you're not going to have many tax implications because of the way in which they'll manage the portfolio to, again, track an index or, customize it to the way you want. And then, you've got this stable of stocks mirrored to some custom strategy for you as an individual investor. And once that's set, then the idea is that we'll do our stuff behind the scenes, the managers of these direct indexing products. And part of that is as they move stocks around to make sure that they're tracking, in this case, who knows what, because you've customized the strategy, they'll do what's called tax loss selling at the same time. So as a basic example here, if you have the S&P 500 that owns 500 stocks, give or take, you're going to basically try to replicate that. Let's say you don't do any customization at all. You're just going to do direct replication of that index. So they go out and buy all 500 stocks at the correct weights. And now you own the S&P, but instead of in an index fund, you own it, all 500 individual stocks. So not all those stocks are going to be going up at the same time the markets are going up. There's going to be actually some that are going down. So the idea here is that they would take the ones that are negative, that you've got losses in, sell those and redeploy those in similar securities to maintain the structure of the portfolio. And now you can use those losses to offset securities that are at a gain down the road when you have to sell them for one particular reason, whether that's, again, to adjust the portfolio to keep it on track, or if you need money out of your portfolio or any other reason that you might incur capital gains in doing that. So the problem here is that there's probably going to be no consistency to how tax loss selling is employed by any of these firms that are running these strategies. Do they do this daily? Do they do it weekly? Do they do it anytime something's at a loss? They just automatically take a loss. I mean, there's going to be no consistency to that type of strategy of tax loss selling as part of the overall direct indexing concept. And when you do that, part of the problem is that now you're accumulating these losses, and that's great. But using back to your example, you put $1 million in this strategy. Let's say that's all the money you have, or 80% of your portfolio or something, and you're a retiree or you're just getting ready to retire. You don't have more money coming in. So everything just went into that strategy at once. So yeah, initially this might work out fine for a couple of years where they're able, maybe even longer, depending on the volatility and what the markets are doing. But you're going to get to a point where hopefully nothing is in your portfolio at a loss anymore, because you're not making new savings contributions in here where you're sort of dollar cost averaging in at different points in the market where some things could continue to be at losses depending on when you invest it. But you take that lump sum and you put it in. At the end of the day, if the markets do well over a 2, 3, 4 year period of time, you're out of losses for the most part. And now you're stuck with hundreds of stocks, low cost basis in these stocks now. And now you got to live on this portfolio. So, it just becomes a tax nightmare down the road. Well, this tax loss selling, it becomes even more complicated if this is a portion of your money and then you have multiple advisors, or you're managing some on your own and you're buying the same individual stocks that they're doing tax loss selling in these accounts, because there's this concept of a tax wash that the IRS doesn't allow you to take the loss if you're basically buying the same security in other related accounts at the same time. So this becomes very complicated to try and coordinate this mess as well. And frankly, some of the robo advisors out there that are not doing direct indexing yet, it's on their radar screen. They're doing still tax loss selling with regular index funds and ETFs. ETF is an index fund, so they're using ETFs as an index strategy, but they're doing tax loss selling. I've heard from several people, including a couple people that became clients, that they don't do it well. They just do it on an automated basis. They're not really coordinating with what is going on in your other accounts or in other advisors you might have, or whatever you're doing on your own. It just becomes a nightmare for your accountant or CPA to unwind at the end of the year, and you may or may not be able to even use these losses.